Hey everyone, welcome back to India Explained. If you love simple explanations on finance, don't forget to quickly hit that like button, share this with a friend, and subscribe to the channel. It really helps us out.
You know that feeling, right? You've been saving up, you've got a budget all planned out, and then all of a sudden, the price just jumps. A lot of the time, the real reason isn't the thing you're buying. Nope. It's a single number that quietly affects almost everything in our lives. And that number has been all over the news lately.
That's the number, 88.5. That's the record low the Indian rupee recently hit against the US dollar. Now, it might just seem like a number on a finance channel, but its impact, well, it ripples right into our homes and straight into our bank accounts. So today, we're going to break down exactly what's going on and, more importantly, what it means for you. Okay, let's dive in.
So, first up, Section 1. Why is this even happening? It might sound super complex, but trust me, it's not. It all starts with a pretty simple idea.
Here's the easiest way to think about it. A country's currency is kind of like its stock price. It's a report card on its economic health. So when the world feels good about India's economy, more investors want to buy rupees, and its value goes up. But when there's uncertainty in the air, well, the opposite happens. And if you look at the rupee's history, it has never, ever been a straight line. It's been a total roller coaster. You can see on this chart how huge global events, like the 2008 financial crisis or sudden spikes in oil prices, have caused these massive swings. So while ups and downs are totally normal, this current dip to over 88 is happening for a very specific mix of reasons. What we're seeing right now is basically a perfect storm. First off, on a global level, the US is keeping its interest rates high. This makes the US dollar the safest, most attractive place for big investors to park their money. On top of that, new US tariffs on some Indian goods are making the markets a little nervous. And then, closer to home, foreign investors have pulled more than $16 billion out of India this year alone. When they sell Indian stocks, they swap their rupees back for dollars, which pushes the rupee's value down.
Okay, so that's the why. Now let's get to Section 2, the part that really matters. How does this all affect your wallet? How does a number on a screen actually make your daily life more expensive?
Let's start with a big one, studying abroad. Just look at these numbers. A $50,000 master's degree in the US would have cost you about 37.5 lakh rupees when the dollar was at 75. But at 88 rupees to the dollar, that same degree now costs 44 lakh rupees. That is a jaw-dropping 19% increase. That's an extra 6.5 lakhs just, poof, gone to the exchange rate.
And it's not just for people going abroad. Think about the phone in your pocket. So many of its parts, the processor, the screen, are actually priced in dollars. So when the rupee falls, companies like Xiaomi have to pay more for those parts. In fact, they said it themselves. They admitted that a 15% drop in the rupee forced them to increase phone prices. That's the cost being passed directly on to you.
And this is where you really see the ripple effect across your entire budget. We import most of our crude oil, right? So a weak rupee means we pay more for it, which means, you guessed it, higher petrol and diesel prices for us. And when fuel gets more expensive, it costs more to transport everything, so the price of your groceries goes up too. And that dream international vacation you were planning? Well, the flights, the hotels, everything is priced in dollars or other foreign currencies, so your budget just got a whole lot tighter.
Now, I know this all sounds like doom and gloom, but that's not the whole story. For some people, and for some huge parts of our economy, a weaker rupee is actually fantastic news.
You can really see the two sides of the coin here. For India's giant IT and pharmaceutical industries, this is amazing. Why? Because they earn their money in dollars. So when they bring that money back to India and convert it, a weaker rupee means they get way more rupees for every dollar earned. It's a huge boost to their profits. But on the flip side, industries that have to import a lot, like airlines buying fuel in dollars, they really feel the pain.
And here's another big winner, non-resident Indians, or NRIs. For the millions of Indians working abroad and sending money back home, this is a golden window of opportunity. Every single dollar, dirham, or pound they send home suddenly turns into a lot more rupees. That means more money for their families to cover expenses, to invest, or to save right here in India.
Okay, quick pause. Before we get into what you can do, I have to share this mind-blowing little finance fact, because the math here is not what you'd expect. So let's just imagine the dollar gets 50% stronger and goes from being worth 100 rupees to 150 rupees. So you'd think, okay, that means the rupee fell by 50%, right? Simple.
Well, nope. It's actually only a 33% fall for the rupee. The percentages aren't symmetrical because the starting point for the calculation changes. It's totally counterintuitive, I know, but it's a super important thing to remember when you're looking at currency movements. A little finance trick for you.
All right,
We've covered the why, the impact, and the winners and losers. Now for the most important part. What can you actually do about it? Let's get into some smart, practical moves you can make depending on your situation.
Okay, first up, for all the middle-class savers out there, the #1 rule is don't panic. First things first, take a fresh look at your monthly budget, because things like fuel and groceries are definitely going to cost a bit more. Second, if you have SIPs in good mutual funds, keep them going. Don't let short-term news derail your long-term goals. And finally, keep an eye on fixed deposit rates. As interest rates rise to fight inflation, you might be able to lock in a really good deal.
Now for the investors. A weak rupee creates some interesting opportunities. Like we talked about, companies that export a lot, like in IT and pharma, could do really well. If you already invest in US stocks or international mutual funds, you're actually getting a nice little currency boost on your returns. Gold is also a classic way to protect your money against a falling rupee. And for all you long-term SIP investors, any dip in the market because of this stuff can be a fantastic opportunity to buy more units on the cheap.
And finally, if you're planning to study or travel abroad, you need to be proactive. Seriously, the very first thing you should do is redo your entire budget using the new, higher exchange rate. Don't hope it'll get better, plan for today's reality. A really smart strategy is to buy your foreign currency in smaller bits over time. This helps you average out your costs instead of getting stuck with one really bad rate. And of course, if you can, book flights and hotels early to lock in today's prices.
So, all of this brings us to the big final question. Is this dip to 88 just a temporary blip on the radar, or is this our new reality? Honestly, the answer depends on all those big global and local factors we talked about. What the US central bank does with interest rates, what our trade balance looks like, and whether that foreign investment money starts flowing back into India. It's something we're all going to be watching very, very closely.
What do you think? Let us know in the comments below. And if you found this helpful, make sure you're subscribed to India Explained for more videos that make finance simple. See you next time.